Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. One more thing before we get started, you'll see in the description of the video there will be this section here, which is click on this link for descriptions, links to the other videos mentioned in this preview on different topics about the SPX indicator. So this is a Google Drive link. I'll show you where it takes you to now. So when you click on that link for the Google Drive, this is where it takes you to, which as you'll see is a list of different topics and links to the videos on the specific topics. These topics go into more detail. We may reference some of these topics very briefly in today's video, but when we reference to go look at the video that provides more details, then you'll just simply click on this link and go to here, and then you'll be able to click on the link that you want to see a more detailed video on a certain topic. Thank you. Hello, in today's video we'll be taking a look at the Thursday, November 20th, 2025 trading session for the CBOE SPX index. We'll be utilizing the day trading GPS SPX Daily Key Levels indicator for our bullish and bearish trade entries, as well as managing our trades. We'll be specifically using the V2.0 version of this indicator, which is the newest version, which just came out a few weeks ago. Okay, so some of you may be already familiar with how this indicator works, but for those who have never seen any of our SPX trading session videos on how this indicator works, I will briefly run through it. This video is going to be shorter than our typical videos, so if you'd like to see more full details about how this indicator works, what all the different levels mean, I would invite you to look in the description of this video, which will have links to other SPX session videos, which will go into more detail about how this indicator works. Okay, so this indicator is for the TradingView platform. And on the TradingView platform, it works on two specific SPX trading symbols. The first symbol that it works on is the one you see on the chart now, which is the CBOE SPX index. That is the official SPX index that everyone follows. And this is the trading symbol that you would utilize the indicator on for trading 0DTE SPX index options. The second symbol that this indicator works on is the SPX 500 8-cap symbol, which I'll show you now. Okay, so this is the SPX 500 8-cap. So in TradingView, you would type in SPX 500, and then you would look for that symbol under the 8-cap exchange. You would utilize the indicator on this symbol if instead of trading SPX index options, you were instead trading SPX through a Forex broker, and in that case you would be trading SPX through a Forex CFD instead of trading index options. Another reason why you would want to use it on this particular symbol is if you were taking a Forex based trading challenge with one of those Forex based trading challenge companies such as FTMO or Apex or the 5%ers or one of the many 70 or 80 different companies that provide Forex-based trading challenges, in which you take a trading challenge to make a certain amount of profit without violating either a daily loss limit or the total loss limit on the challenge account. And then if you pass, then they will award you a funded trading account in which they provide the risk capital, and then you do a profit split with them, which typically would be somewhere between 80 to 95% profits in your, that you get to keep, and then the rest the smaller percentage goes to them for providing the risk capital. So if you were taking a trading challenge of one of those companies, then you would also trade SPX through a CFD versus trading index options. Another reason that even if you are trading SPX index options through the CBOE SPX symbol, why you might want to have a second chart open with this 8 cap symbol is that you would get the levels for CBOE SPX at 9 a.m. Eastern Time, 30 minutes before the 9:30 a.m. Eastern New York Open of the CBOE SPX Index. So if you have it on this particular symbol on a second chart, then you will see the levels for the SPX 500 8 cap as you see here, and also in this table here. But then you also get this additional table here, which will give you a preview to the CBOE SPX Daily Key Levels at 9 a.m., which I have marked off here. So at the open of the 9 a.m. candle, this is what you will see while you have it on this particular symbol. And then you get these levels for CBOE SPX 30 minutes before it opens at 9:30 a.m. Eastern. This gives you a 30-minute jump on the session to do some further analysis and do some planning before the 9:30 a.m. open. Okay, so we're back on the CBOE SPX chart. As you can see, this is on a 2-minute chart time frame. That is the recommended chart time frame for the daily key levels trading strategy utilizing this indicator. However, the recommended chart time frames are anywhere between 1 minute and 5 minutes for utilizing this strategy with this indicator. However, we have found that the 2-minute chart time frame to be the most consistent performer within the 1 minute to 5 minute range, and that is the chart time frame that you will see us using on all of our SPX session videos. If you prefer a 1 minute or 3 minute or 5 minute, that is fine as well. However, just keep in mind that we have found that the 2 minute to be the best performer within that particular range. Okay, so as far as the key levels that the indicator gives, at 9:30 a.m. Eastern New York Open on the first tick, you will get the daily key levels on your chart for CBOE SPX. The most important key level is going to be the SPX Bull Bear KPL, which stands for key price level. So for the Thursday, November 20th, 2025 session, the indicator gave that level as 67.4069. So what this level is that it is the important bull bear pivot level for this session. So each day you're going to get new updated key levels and a new updated bull bear key price level for that particular session. So for this session, 67.4069 is the important bull bear pivot for this session, meaning bullish above and bearish below. Keep in mind that this is the initial bias for the session, and that mainly for trading the 9:30 a.m. opening candle, as well as other candles in the opening moments of the session. The other main key levels that you can take bullish or bearish trades on with this indicator are going to be your R1 through R6 levels above the bull bear KPL, and then your S1 through S6 symbols below the bull bear KPL. So those levels are going to be your trading levels, and then the other levels that you see, such as these QL levels and midpoint levels, have different purposes, and those are not levels that you would be taking trades from. However, they serve other purposes. For example, the QL levels are going to be levels that you can enable in the user control panel, and those are used for tight stop losses, with the QL below being the tight stop losses on bullish trades from particular levels, and the QLs above levels are going to be your tight stop losses on bearish trades from those particular levels. As you can see here, we don't have the QL levels turned on for every single level. is that is unnecessary to have on your chart. You can simply turn them on in the user control panel as the session progresses for if you prefer to utilize tight stop losses on your trades. The midpoint levels that you see here above and below are going to be your standard stop loss levels. So the midpoint levels above a level are going to be your standard stop losses on bearish trades from a particular level, and the midpoint levels below a particular level are going to be your standard stop losses for bullish trades from that particular level. The midpoint levels also serve additional purposes for gauging continuing momentum on trades once they've reached a certain threshold of profitability, and they also serve as additional waypoints for decision making for either exits or for stop loss adjustments once a certain type of trade that you would have with this indicator has reached a minimum target threshold for a continuing move in your favor, as we will see as we go through how the two different types of trades work with this particular indicator, which are scalp trades and regular trades. The other levels that you see here are the PMH, which is the pre-market high, the PML, which is the pre-market low, the YDH, yesterday's daily high, which is specifically the previous day's RTH session high, YDH, which is yesterday's daily close, which is the previous RTH session close, and the YDL, which is yesterday's daily low, specifically the previous day's RTH session low. So these key levels are also important in terms of context of the session. So for example, for a bullish move in any particular session, not only is price going to have to start closing consecutive candles above the bull bear KPL for an extended bullish move, but it's also going to have to break above the pre-market high and also sustain candles above the pre-market high for any sustained enlarged bullish move. Conversely, the pre-market low, for there to be any substantial move to the downside, not only is price going to have to start closing below the bull bear KPL level, but it's also going to have to start closing below the pre-market low and stay below that for there to be any extended move to the downside. These levels, as you can see here in this comment here, also can serve as additional waypoints for decision making for exits or stop loss adjustments if any of those levels happen to be in the direction of your trade. If they occur after a minimum profit threshold has been met, they also serve as additional waypoints for decision making as well, for either profit taking or for adjustments to stop losses. As you can see here, these levels are also displayed in a table, as well as the main key levels here are also displayed in this table. These tables are optional. They are independently controlled. What I mean by optional is that you can turn them off if you don't wish to have them on the screen, because you do have the line labels here for the prices and what the specific levels are. And these are independently controlled, so if you do wish to have them on the screen, you can control the size and appearance of these tables as well as where they are placed on the chart independently of each other, or as I said, you can turn off one of them or also turn off both of them if you don't wish to have them on the screen. Also, the line labels that you see here are also individually controlled by groups. So for example, the R1 through R6, S1 through S6 in the bull bear KPL are a group, the midpoint levels are a group, and the QL levels are a group. So what I mean by group controlled is that you can control the size by group of these line labels, and you can also control the offset, moving any of the groups over more to the left or more to the right, or you can have the offset set the same for them as I have here, so they're all straight up and down. Also, the PMH and PML is a group, YDH, YDC, and YDL is a group, and those are also independently controlled, both for the size of the text of the line label as well as the offset on the group as well. So as you can see here, these main key levels, R1 through R6, the bull bear KPL, and S1 through S6 are all in the large font for those levels, and also the PMH, PML, YDH, YDC, and YDL are also in the large font, while the midpoint levels are in the normal font, and then the QL levels are in the small font. Those are all independently controlled. If you wish to have them be different sizes than what they are here, then you can simply control those by group and change it to either small, normal, or large, whichever you prefer. Okay, so now we'll just get into the trades of the day here. So we're going to be looking at several different trades on several different screenshots here. So there was not enough room to put all of the trades with all of the comments on one screen for today. So we're going to be looking at several different screenshots as the session progresses. So the first screenshot we have here is going to go over the opening candle trade, which is the 9:30 a.m. opening candle here, marked off for the session. And as you can see, this candle opened slightly below the bull bear KPL, then it crossed above and closed above. The most important aspect of this 9:30 a.m. opening candle, if you're inclined to take the 9:30 a.m. opening candle trade, is where it closes. So in this case, even though it opened below, it closed above the bull bear KPL. So that is the most important aspect. The second most important aspect of it is it within the acceptable range for a trade off of the particular level? In this case, the bull bear key price level, and in this case, this candle is within the acceptable range. What do I mean by acceptable range? There is an acceptable range and unacceptable range. So we do have a video which goes into more detail on this aspect of acceptable range and what are 9:30 a.m. opening candles to avoid and how to recognize them. And there's also a PDF document that accompanies that particular video which goes into more detail about acceptable range and unacceptable range, and that is found in the Google Drive link that you will see in the description of this video, which is a link that takes you to a document on other particular topics about this indicator. And once you click on that link, you'll see a list of varying topics on specific topics on this indicator, of which that is one of them. And then there's also not only a link to that video about acceptable range, but also that accompanying document. So we're not going to go into that now, but you can take a look at that video, which will give more details about that aspect of this indicator. So for right now, we're just going to go over that this is within the acceptable range. So this is a bullish trade entry for this 9:30 a.m. opening candle. Now with this indicator, the 9:30 a.m. opening candle trade is part of the Daily Key Levels SPX option strategy. However, it is not a there's no rule or obligation that you, as part of the strategy, have to take the 9:30 a.m. opening candle trade. It is an optional trade. Many traders prefer to let the session play out for the first 5, 15, or 30 minutes or an hour, depending on what type of trader they are. Other traders prefer to take the 9:30 a.m. opening candle trade. So if you're more inclined to do that, to take a trade at the open, then those are the rules regarding the 9:30 a.m. Opening candle trade, which you can see in that other video I was talking about, if you're inclined to do that. However, if you're more of the mindset that you prefer to let the session breathe a little bit and let the first shakeouts of the session occur, and instead take your first trade later on in the session as you see price action dictating how the session is going to go later on, then that is fine as well. Okay, so regarding this, as you can see, it did open below, it crossed above and closed above. So that is a bullish trade entry on this candle. Now, other trade entries just explain how this works, that the most important aspect is where is it closing. So in this case, it closed above. If this candle had instead crossed above but then ended up closing below and had done the reverse of what happened here, then this would be a bearish trade entry on this particular candle. Also, the most important aspect is where is it closing. So where it opens is not so much as important as where it is closing. So for example, this candle could have opened above, stayed above, never crossed below, and closed above. That's still a bullish entry signal. Conversely, if it opened below, stayed below, and closed below, then that is a bearish entry signal. Also, if it had opened above the bull bear KPL, crossed below, and closed below, that is also a bearish entry signal. The most important aspect, as I said, is where is the opening candle closing, as long as it is also within the acceptable range. So if it's closing above the bull bear KPL within the acceptable range, that's bullish trade entry. And if it is closing below within the acceptable range, then that is a bearish trade entry. Okay, so what about stop losses? So on this bullish trade, on this 9:30 a.m. opening candle, the trade level is the bull bear key price level. On a bullish trade taking off the bull bear key price level, then your tight stop loss is the QL below the bull bear KPL, which is this level here. The standard stop loss is your first midpoint level below the level you're trading, in this case the bull bear KPL, and that is this level here. Now, whether you want to use a tight stop loss or a standard stop loss is simply up to each individual trader to decide for their risk profile. So the tight stop losses are going to give you less money at risk on the trade. However, they are more prone to getting stopped out in most sessions. So as long as you're aware of that, some traders prefer to use tight stop losses, and within the context of they already know that they are going to be more prone to getting stopped out. However, they prefer to be under that scenario, and if need be, if they are stopped out, then reassess and look for an additional trade entry. The standard stop loss, you're going to be a lot less prone to getting stopped out. And again, it just depends on your risk profile. You will have technically more at risk under the standard stop loss. However, in most cases, they are a lot less prone to getting stopped out. In this particular session today, if you were not doing a scalp and you were instead doing what we term a regular trade, then eventually you would have gotten stopped out here. However, you would have then been able to enter again on a bearish trade either right after that, or on a bearish trade on the S1 level if you preferred not to enter here, but instead enter on this particular trade level, the S1 level, which we'll get to this in a second. So with this particular indicator, your initial stop losses on trade entries, whether they're bullish or bearish, are going to be level based. And then later on, if you are doing a trade, which we term a regular trade, which gives you stop loss adjustment options once the trade has reached a certain threshold, then you were changing your stop loss at that time to a price-based stop loss, which is just based on the price that you paid for the option. So on the initial trade entry, your stop losses are going to be based on a level. Now, in the link to the Google Drive document, which I talked about earlier, there's also going to be a video on how to place stop losses on options that are based on the price of the underlying, which means the price of the instrument that you're trading, in this case the SPX, which essentially is a level-based stop loss on options. There's two different brokers that we're aware of that offer that type of feature when trading options, as far as a price level based stop loss on options. And one is Thinkorswim, which is owned by Charles Schwab, which there's a link to that video off of that Google Drive link, which goes into how to use that feature for Thinkorswim if you use Thinkorswim but you were not aware of that feature, and it goes into detail about how you can utilize that feature on Thinkorswim. The other broker that offers that feature is Interactive Brokers. If you use Interactive Brokers, then you can simply ask their support staff how to utilize that feature, or you can simply Google how to utilize that feature, and it'll take you to either some YouTube videos on it for Interactive Brokers, or it'll also, there's several different Reddit conversations about it where other traders will go into how to utilize that feature. The Thinkorswim platform also offers that feature on their mobile app, so that is an advantage for people that like to trade on their mobile app, whereas the Interactive Brokers does not offer that feature on their mobile app. They only offer it on their desktop app. So if you utilize one of those two brokers for making trades, then you can utilize that feature. Or if you don't utilize either one of those brokers, then you need to ask your broker if they offer that feature. Some other brokers may offer it. You just need to find out if your broker does offer that feature. If your broker does not offer that feature and you don't want to switch to Thinkorswim or Interactive Brokers, then you're going to have to either set an alert on TradingView for when SPX hits the stop loss level, in which case then you would just be manually stopping yourself out by manually closing the trade out, or you're just going to have to watch the chart to see if it hits that level to manually close your trade out. But as I mentioned, later on, after a trade moves in your favor to a certain threshold or greater, then you are adjusting your stop loss to break even or break even plus a profit buffer, and at that time you're no longer using a level based stop loss. You are then using a price based stop loss on your options, which all brokers offer that. Okay, so as we said, this is the tight stop loss on this trade, and then the midpoint below is the standard stop loss. Now, as far as what particular options that you would use for 0DTE on this particular trade, with this indicator on any particular trade, bullish or bearish on any of the main key levels, there are always going to be three different strikes that you can utilize. So we do also have a video on that specific topic, so if you would like to look at a video that goes into more detail on that, then you can simply go to that Google Drive link and in the description of this video, click that on, and then you'll also see a video that goes into more detail on that topic. However, for today's session, we'll explain those on the particular trades from the different levels that we'll see on the different screenshots and how we do that. So with this particular trade here, on this bullish trade from the bull bear KPL, you have three different strikes that you can utilize. So the first strike is going to be the standard play, which is the at the money option. In this case, it's a call option since it's a bullish trade. And the standard play is going to be the closest strike to the level that you're taking the trade from. In this case, the level we're taking the trade from is the bull bear KPL, 67.40.69. So that is going to be the 67.40 strike. If you're not familiar with SPX options and how they work, they trade in 5-point strike increments. So for example, 67.30, 67.35, 67.40, 67.45, etc. So the 67.40 is the closest strike, and since this is a bullish trade, then that would be the 67.40 call option. Now what about out of the money strikes? There are two out of the money strikes that you can consider on this trade. How you figure that out is with this particular indicator is that you look at the level you're taking the trade from and then the direction of the trade. In this case, a bullish trade, so we look up from this level, and the first out of the money strike is going to be the strike closest to the midpoint level above the level we're taking the trade from. In this case, that is 67.51.32 on this midpoint level here. The closest strike to that is the 67.50 0DTE call option. What is the furthest out of the money strike you can consider using on this is going to be the first full level above the level that you're taking the trade from. So we're looking above, since this is a bullish trade, one full level above is the R1 level, 67.62.34. The closest strike to that is going to be the 67.60 0DTE call option. So that is going to be the furthest out of the money strike that you can consider for this particular trade. If, for example, this was a bearish trade, we had the opposite situation here, then just to explain, you would still have the 67.40 as being the at the money standard play. However, since it would be bearish, it would be a 67.40 put, and then for the out of the money strikes, you would look down since it would be a bearish play, and the first midpoint down would be the midpoint here, 67.29.87. So your first out of the money strike on a bearish play would be the 67.30 put, and then the furthest out of the money strike on a bearish play would be the full level down, 67.19.04, and that would be the 67.20 put. Now you're waiting until the close of this candle to one, confirm the direction and the bias, and then you are also buying the option on the close. So the buy price on the 9:30 a.m. candle close, so remember this is a 2-minute chart, so that means this is closing at 9:32 a.m., is 29.68 for the 67.40 call, the at the money, and then the two out of the monies, the 67.50, the price was 23.11, and the 67.60, the price was 17.80. Now we'll also be taking a look at the thinkorswim data boxes later on in this video, so you can see the prices on the 2-minute chart, specifically charts of the options. But we will get to that later on in this video. Okay, so here we have the 9:56 a.m. candle. As you can see here, it hits the R1 level. So this is what is known with this indicator as a scalp only trade. There are two different types of trades with this indicator in this daily key level strategy. The first is a scalp only trade. On a scalp only trade, you're looking for a one level move in your favor, and then you are closing out all of your contracts. So regardless if you're trading one option, 3 options, 5 options, 10 options, 20, etc., on scalp only trades, you are closing out all of your contracts when it hits the target one level move in your favor. There's no stop loss adjustments, there are no other adjustments to make. You are simply closing out on scalps. So if you were doing a scalp only trade, then you're closing out your trade here and taking your profit. The other type of trade that you have with this particular indicator and the strategy is what's termed as a regular trade. A regular trade, you're looking for a minimum 1.5 level move in your favor, and then you have all these different options starting at that 1.50 level move in your favor for a regular trade. So when you make a trade entry, you need to know when you're making that entry if you're going to be utilizing that trade entry for either a scalp or a regular trade. So then you will know which particular target that you're going to be looking at, and then what your action is going to be once it hits that target. So if you have a scalp only trade on this, then you are closing out all of your contracts here. However, if you were looking for a regular trade, then you are looking for a 1.5 level move in your favor. So how you determine the length of the move in your favor is you look at the level that you're taking the trade from, in this case the bull bear KPL. The direction of the trade is up since it's a bullish trade. One full level up from this is R1, so that is your one level move in your favor, whereas a 1.5 level move in your favor would be the next midpoint level above R1. So this is one level, this is 1.5 levels, and for example R2 would be 2 levels from this level. As you can see here in this trade, it didn't quite make it to the 1.5 level move. So if you did a scalp, you're out here. However, if you were looking to do a regular trade on this particular trade entry, then it missed the mark here, and instead you would have gotten stopped out. Here on the 11:02 a.m. candle, you were stopped out if you used a tight stop loss, and then on the 11:04 a.m. candle here, then you were stopped out on this wick below when it hit the standard stop loss here. Now, if you were doing a regular trade here, then you got a loss on these options here. First, we'll go to the scalp and look at the profits on that. So if you did a scalp only, then the prices on the 9:56 a.m. candle close here on this candle here. This at the money was $34.50 for the 67.40. That was a $482 profit per option. The 67.50 was a $27.20, so that's a $409 profit per option. The 67.60 was $20.50, so that is a $270 profit per option. Now, if instead you were doing a regular trade, like I said, you were stopped out here, and the prices on the stop out on the tight stop loss in the 11:02 a.m. candle, these prices are the worst prices within this candle, meaning this is the worst case scenario price on getting stopped out on this 11:02 a.m. candle on the tight stop loss. So you may get stopped out at a better price than this. However, this is we're taking the worst case scenario here. So on the 67.40, the stop out on this tight stop loss was $15.70. That's a $1,398 loss per option. On the 67.50, it was $11, so that's $1,211 loss per option. The 67.60 was $720, so that is a $1,060 loss per option. If instead you use the standard stop loss, then the prices on the 11:04 a.m. candle stop out were $12 on the 67.40, so that's a $1,768 loss per option. The 67.50 was $820, so that's $1,491 loss per option. and the 6760 was 520, so that's a $1,260 loss per option. So then after that, you could have re-entered here on either the 11:06 a.m. candle or 11:08 a.m. candle for the BBKPL. So excuse my typo here, where I just typed in BBKL instead of BBKPL. So my apologies for that. But as these candles are still within the acceptable range for the bull bear key price level for a bearish trade. So if you got stopped out here because you didn't take a scalp and you instead were doing a regular trade, then you could have re-entered here on for a bullish trade on the bull bear KPL. However, if you did not want to do that, then your alternative is here on this 11:14 a.m. candle, if instead waiting to enter for a S1 bearish trade. So here we have a cross below and close below the S1 level. This is still within the acceptable range for this, for a trade off of the S1 level where it closed. So on this candle close here, then you could have entered a bearish trade here. Now we're going to go into these bearish trades on the next screenshots and go into the details of those trades. However, we wanted to lead into it here on this particular one. Okay, so now we're going to move to the bearish trades in the next screen. Okay, so here we're in the next screen here. Now this is going to be looking at a couple of different scenarios. So in this particular scenario, we're just going to look at if either you were taking this trade as your first trade of the day, as I said in the beginning of the video, that you don't have to take this 9:30 a.m. opening candle trade is optional part of the strategy. So if you were taking this trade as your first trade, then you have a cross below, close below the bull bear key price level here on this 11 a.m. cross below, close below the bull bear key price level. Then we're also going to be taking a look at the on another screen what the scenarios would have been for taking the trade on this S1 bearish trade here if you were stopped out, as we talked about earlier, if you did take this trade and we were on the 9:30 a.m. opening candle, did not take the scalp, and then you were stopped out on your opening candle trade. Okay, so on this particular trade here, we have a bearish entry on a trade of the BBKPL level on this 11 a.m. candle, cross below, close below, and this candle is within the acceptable range. Also, keep in mind that some of these subsequent candles here are also within the acceptable range. So if you did not take this trade here and were instead looking for additional confirmations, then you could have also taken the trade here on some of these subsequent candles, as they are also within the acceptable range for a bearish trade off of the bull bear KPL. Your standard stop loss on a bearish trade from the BBKPL is the first midpoint above the BBKPL here, which is 67.51.32. A tight stop loss on this bearish trade is the QL level above the BBKPL, which is the level here, the 67.46.10. As you can see in this particular trade, neither one of these stop losses was hit on this particular trade. Also keep in mind that we did have a significant gap up from yesterday's daily close, so this is about a 100-point gap up. So another thing you want to keep in mind as far as the general context on the overall session here is that we have a 100-point gap up on this initial opening here from yesterday's daily close. So in most cases, when you see a significant gap up of that magnitude in the 100-point plus range, then there is a very good likelihood that at some point in the session there is going to be a test of that gap and perhaps a gap fill. That doesn't happen all the time. However, in that magnitude of a gap, it does happen more often than not. So that's one thing to keep in mind when you have a magnitude of a gap to this magnitude of 100 points plus, is that you have to be wary of the fact that is there going to be that much more upside left in this move, at least at the initial part of the session. Okay, so we have our stop loss levels here. So the strikes that you'd be using on this trade are basically figured out the same way that we did on the other screen, and one is going to be the at the money, which is going to be the standard play. So that is going to be the strike closest to the level we're taking the trade from. In this case, the bull bear KPL 67.40.69. So that is going to be the 67.40 0DTE put option. And then for out of the money strikes, then again, as we pointed out earlier in the video, you look in the level that you're taking the trade from. The direction of the trade is below, since this is a bearish trade. So the first out of the money strike is going to be the closest to the midpoint level below the level we're taking the trade from. In this case, 67.29.87. So that is the 67.30 put option. And then the furthest out of the money is going to be the closest strike to the S1 level, one level below the level we're taking the trade from, 67.19.04. So that's going to be the 67.20 put option. Now, as I mentioned earlier, if you took the 9:30 a.m. bullish trade and you were stopped out because you did not take the bullish scalp close out on the R1 hit, and you stayed in for the regular trade, then you were stopped out on either the 11:02 or 11:04 a.m. candle. And then, as we mentioned earlier, then you could have entered a bearish play on the close below the BBKPL on the 11:06 or 11:08 a.m. candle, if you were inclined to immediately jump back into a reversal trade, as they were still within the acceptable range for a trade off of this level. And if you did that, then we're going to point out what the prices would have been for that. All of the prices that you see here are going to be based on taking this trade off of this level here. So as far as the profits and all that, they're all based on this. So if you were instead going on this reversal trade here and jumping in on the 11:06 or 11:08 a.m. candle that were still within the acceptable range after getting stopped out, then you would simply adjust these profits based on paying these prices depending on which candle you got in on, as opposed to these prices here. Okay, so here we have the S1 hit on the 11:14 a.m. candle here. That's a scalp only. As we mentioned earlier, 100% closeout on scalp only trade, and the prices on the closeouts are going to be based on the candle close. As you can see here, it did wick down below that. So if you actually got out on the touch of the level as opposed to the candle close, which we're basing these on, then you would have gotten a better price than this, because there was more profit as it went down further. And as you can see here, it backed off and closed slightly above that level. So all of these prices are based on candle closes. In some cases, the candle close will be to your detriment, as opposed to getting out when it actually touches the level. And in other cases, as you'll see here, then you'll also be getting a better price. The main thing is that on your closeouts, you want to keep it consistent. So either do your closeouts on candle closes, or do your closeouts on touches of the level. As I mentioned earlier, there are a couple of platforms that allow you to actually base stop losses on the price of the underlying, and those same platforms also allow you to do take profit trades based on the price of the underlying as well. So if you use one of those particular brokers we talked about earlier, then you can also base your take profits based on the price of the underlying as well. And so that way, if you are more inclined to do touches of the level for your closeouts, then you can utilize that feature. However, if you're not, then you can simply do it on candle closes. So the prices on the 11:14 a.m. candle close, the at the money 67.40 was 37.60. Remember that we're basing these on these prices here, these profits. So if you instead took that other trade here and were stopped out, then you paid the higher prices here, then you would simply adjust these profits down accordingly based on these being your buy prices instead of this. So the 67.40 was 37.60. That's a profit of $1,760 per option. The 67.30 was 31.10. That's a profit of $1,560 per option. The 67.20 was 25.40. That's a profit of $1,310 per option. Okay. Then here on the 11:16 a.m. candle, that is on a regular trade, we have a 1.5 level minimum required move in our favor for a regular trade, which brings in all of these different options here now on a regular trade. On the candle close on the 11:16 a.m. candle, the 67.40 was 38.60. That's a profit of $1,860 per option. The 67.30 was $32.20. That's a profit of $1,670 per option. And the 67.20 was 26.40. That's a profit of $1,410 per option. Now on a regular trade on a 1.5 level minimum required move in your favor, once you have reached this level here, then you have the following options available to you. Either 100% closeout of all option contracts, or adjust your stop loss on all contracts to break even, or break even plus a 10 to 15% initial profit buffer, which that is what PB stands for. Or if you're trading multiple contracts, you can close out 70 to 90% of the multiple contracts meaning 3 or more. So for example, if you were trading 3 and you closed 2, that's roughly 67%. If you were trading 4 and you closed out 3, that's 3 is 75%. If you were trading 5 and closed out 4, that's 80%. If you were trading 10 and closed out 7, that's 70. 10 and closing out 8 is 80. 10 and closing out 9 of them is 90, as an example. Then at each succeeding level move in your favor after the minimum required 1.5 level move, then you have the same options decisions to make at each succeeding level move in your favor. Also, after the 1.5 level minimum required move in your favor on the regular trade, if there are any of these levels, the PMH, PML, YDH, YDO, and YDC levels, happen to be in the direction of your trade after the 1.5 level move threshold has been met, then those are also waypoints for closeouts or SL adjustments. If you already adjusted your stop loss at the 1.5 level move in your favor, then you can add additional profit buffers at each level move in your favor if you're so inclined to do. if you do not close out any remaining contracts at each succeeding level move in your favor. So starting here with this, then you have all of those options available to you. Now here on the very next candle, as you can see here, it wicked down and it hit the S2 level here. That is now a 2-level minimum ideal move on a regular trade. Now, the difference between a minimum ideal level move and a minimum required move, 1.5 level, is that on normal to low volatility days, a 2-level move is basically going to be the extent of most moves. Now, low to medium or normal volatility sessions are going to generally comprise about 80% of the sessions you see in a normal year, 75 to 80% or so sessions. So in those types of sessions, that is generally a 2-level move in your favor is generally going to be the full extent of most moves that you will see in those types of volatility environments. However, today's session is a high volatility environment. It's not an extreme volatility environment, but it is a high volatility environment. That's why we see the elevated option prices to begin with, and a lot of that is based on this 100-point plus gap up, which triggers the higher volatility setting for this particular session. So in the higher volatility sessions, then the normal is going to be more than 2-level moves in those sessions. In those types of sessions, you're going to see more of the 3-level and above moves as being the norm in higher volatility. And then in extreme volatility, you're going to see more of the 5 to 6 level or above 6 level moves. And with this particular V2.0 indicator, this indicator will actually go up to 10 levels below and 10 levels above the BBKPL. The reason why we don't have all 10 levels on is we're not in an extreme volatility environment, such as we saw, for example, with the COVID pandemic and also in the 2007-2008 meltdown financial crisis, that we saw extended periods of extreme volatility. If we do have extreme volatility periods that we enter into again, then you can simply turn on the R7 through R10 and S7 through S10 with this V2.0 indicator to have those additional levels. Okay, so on this S2 hit here, the 1118 candle on the candle close here, as you can see, again, we have a situation where it wicked down. So if you actually got out on the touch as opposed to the candle closed, and the prices would have been higher here than we're showing on the candle close, which then backed off. The 67.40 put was 46.40. That is a profit of $2,640 per option. The 67.30 was 39.40. That's a profit of $2,390 per option. The 67.20 was $33.10. That's a profit of $2,080 per option. Now here we have on this 11:30 a.m. candle, which is 12 minutes later, we have a YDH hit. So again, going back to this level, this note here, after the minimum 1.5 level move in your favor, then any PMH, PML, YDH, YDL, and YDC level that happens to be in the direction of the move continuing in your favor after that minimum threshold's been met, those are additional waypoints. So at these, when it hits those levels after the 1.5 level move in your favor, then you have the additional options to consider, either further adjusting your stop loss or closing out. Okay, so the YDH hit 11:30 a.m. Candle prices on this candle close, as you can see, are more in your favor. So in this case, if you got out on a touch, then you would have gotten a lesser price. However, we're keeping it consistent, as I talked about earlier, that you either get out on candle closes, which will sometimes work more in your favor, sometimes less in your favor, or make it consistent to get out on the touches. In this case, in this candle close, it is more in your favor. So on the 67.40, it is 57.40. That's a profit of $3,740 per option. The 67.30 is 49.40. That's a profit of $3,390 per option. The 67.20 is $42.10. That's a profit of $2,980 per option. Now here, 6 minutes later on the 11:36 a.m. candle here, we have a hit of mid S2, S3. That's now a 2.5 level move in your favor. So this is now an additional waypoint for decision making. The prices on the 11:36 a.m. candle close, as you can see, this is also in your favor on the candle close. The 67.40 put is $67.70. That's a profit of $4,770 per option. The 67.30 put, $59.60. That is a profit of $4,410 in your per option. The 67.20 is $51.70. That's a profit of $3,940 per option. Now here at the 11:46, 10 minutes later, you can see it hits the S3 level. That is now a 3-level move in your favor. So again, you take the level you're taking the trade from. This is 1 level move in your favor because we're taking a bearish trade. 1.5, 2 levels, YDH level, then 2.5 levels here, and now S3. That's 3 levels in move in your favor. Prices on the 11:46 a.m. candle close, in this case, it backed off. So if you got out in the touch, these would be better prices. However, in the candle close, keeping it consistent, in this case, it is less in our favor. The prices on the candle close, 67.40 is now 81.90, profit of $6,190. 67.30, $73.50, profit of $5,800 per option. 67.20, 65.10, profit of $5,280 per option. Next, we have the 11:54 a.m. candle here. As you can see, this sliced through S3 again, but it also went down to the YDC level, but stopped short of the mid S3, S4 level. So again, going back to this here, this note here, this is again, YDC is in the direction of the trade after the 1.5 level move. So this is then an additional waypoint for decision making. Now, this also is a 3-level move in your favor because it did have S3 again. However, this is hitting the YDC level. 67.40 put on the close of the candle here. As you can see, that's more in your favor on this particular candle close because it did close below. 67.40 put, $107.40, profit $8,740 per option. 67.30 put, 98.20, profit $8,270 per option. 67.20 put, $89.30, profit $7,700 per option. Now here on this candle here, we have the mid S3, S4 hit. That's now a 3.5 level move in your favor on this regular trade. Prices on the 11:56 a.m. candle close, as you can see, that is more in your favor here versus just doing the touch of the level. 67.40 put on the candle close, $111.20, profit $9,120. 67.30 put, $102.70, profit $8,720. 67.20 further side of the money put, now $93.70, profit $8,140. Next, at 11:58 a.m., just the very next candle, here we have a touch of the S4 level in this candle. Price, this is now a 4-level move from bull bear KPL to S4 on this regular trade. Price on the candle close, as you can see here, it is less in your favor on this candle close. These prices, however, are in the candle close after it backs off. 67.40 put, $123.50. Profit $10,350 per option. 67.30 put, $114.10. That is a profit of $9,860 per option. 67.20 put, $105.70. That's a profit of $9,340 per option. Here, 12 minutes later on the 12:10 candle, as you can see here, it hits the YDL level. That's yesterday's daily low. So that prices on this 12:10 p.m. candle close, as you can see, slightly more in your favor than just a touch. Prices on the candle close, 67.40 is now $138.40. That's a profit of $11,840 per option. The 67.30 put is $128.50. That's a profit of $11,300 per option. The 67.20 is $119.80. That's a profit of $10,750 per option. Now, as you can see here, 6 minutes later, mid S4, S5 hit. That's now a 4.5 level move in your favor on this regular trade. As you can see, this candle happened to close right on the level. So in this case, both the touch and the candle close would have been basically the same result. Prices, however, are based on the candle close. 67.40 put, now $150.70. That's a profit of $13,070 per option. The 67.30 put, $141.20. That's a profit of $12,570 per option. The 67.20, $132.50. That's a profit of $12,020 per option. Now, after hitting this level, it did come close to the S5 level. However, it did start and try to get a rally here, starting with these candles here, which came just $1 or so away from hitting the S5 level, but nevertheless it did not hit it. So it did go back up to the mid S3, S4 level here, as you can see, before resuming the downtrend here. And at the 1:50 p.m. Candle here on a regular trade, you have the S5 hit. Now we have a 5-level move down from this level here. Prices on the candle close, as you can see, are more in your favor than the touch. These prices are based on the candle close. 67.40 put, $175.90 per option. So that is now a profit of $15,590 per option. The 67.30 is $165.70. That's a profit of $15,020 per option. The 67.20 is $155.80. That's a profit of $14,350. Now keep in mind that this is 1:50 p.m. There's now 2 hours and 10 minutes left in the session. So at this point, whatever contracts you still have left in this trade here, you would be more inclined to either do one of two things. Either further tighten up your stop loss, because now we're running out of time. There's only 2 hours and 10 minutes left in the session, or close out any remaining contracts here, as again, we're running out of time in this session. If you did, so this would be the point of which you would either want to just close out everything because of the time factor involved, or further tighten up your stop losses by adding a lot larger profit buffer. In this case, you would want to add a profit buffer that would be very close to what these prices are. So we're either just going to get a further move in your favor, or you're just going to get stopped out on any remaining contracts, and you would have your profit locked in at something that would be close to these close to these levels. If you did happen to do that, then as you can see here, eventually it would have gotten stopped out here. However, if you did your adjustment to the point or where it was more liberal than that, and you were actually still in the trade here at the during the end of the session here at 346, it did happen to hit the mid S5 S6 level here on the 346 candle. These candles here did not quite make it. They came very close. This one here actually traded and touched it and went through it. And on, if you happen to have any contracts remaining here, then the 67.40 put on the 3:46 p.m. candle close was 198.30, a profit of $17,830 per option. The 67.30 was 188.30, that's a profit of $17,280 per option, and the 67.20 was 178.30, a profit of $16,570 per option. Now on the next screen, we're going to take a look at a trade. Now, before we go into that, just keep in mind, as I said earlier, if you were stopped out and you had a loss on the opening trade, because instead of doing the scalp close, you instead tried to stay in on the regular trade, and then you got stopped out on either the 11:02 or 11:04 a.m. candle, then you could have entered on the 11:06 or 11:08 a.m. candle on a bull bear KPL bearish trade, and then these were the prices here instead of these. So if you instead did that, then you would take a little bit off the profit of these different closes here, because now you're going to base them on these. So for example, instead of the price being $20 on the at the money, you were instead either paying $22.95 or $25.50. Instead of the $15.50 on the 67.30, you were paying either $18.30 or $20.10, and instead of $12.30 on the 67.20, you were either paying $14.50 or $15.90. So then you would just take that amount of profit per contract off of these different levels you see here, because these are all based on these particular prices. So in the next screen, we'll take a look at the S1 bearish trade. So if you did not get in on these reversals here after the stop out, if you did get stopped out, then your next opportunity would have been this candle here, which we'll take a look at in the next screen. Okay, so here we have the 11:14 a.m. candle. So this is a bearish play off of the S1 level. As you can see, it crosses below and closes below the S1 level. Also keep in mind this 100+ point gap up, and what we talked about earlier as far as keeping that in the general context of the session. When you see a 100-point gap, it could be a gap in either direction, whether it is above or below. On that sort of magnitude of gap, then the odds favor in many cases a attempt at a gap fill. That doesn't mean it's not 100% that there's going to be a gap fill attempt during that session. It's just keeping in mind that this is not a 20 or 30 point gap or a 50 point gap. This is a 100+ point gap. So when you see gaps of that magnitude, the odds are more favoring at least an attempt at a gap fill. So again, that's just keeping in context but how much further upside there is in any bullish play, at least at the beginning of a session, when a gap of that magnitude is presented. Okay, so this is an S1 bearish play here. So again, if you have on the 11:14 a.m. candle, and this candle close is within the acceptable range for this, and again, you can go back and look at that video on acceptable and unacceptable range. For the BBKPL level, however, the acceptable and unacceptable range also applies to trades off of any of the other levels as well. So if you want to take a look at that video, that's in that Google Drive link that's in the description of this video, which is on that topic, and also the accompanying PDF document, then you can look at the acceptable, unacceptable range. So this is within the acceptable range, and now we have a bearish entry on this particular level here, the S1. So the at the money play here, the standard play, is going to be the strike, which is closest to the level we're taking the trade from, S1 67.1904. So that is going to be now the 67.20 0DTE put option. So in this case, since this is a bearish trade, now we have our two out of the money strikes we can consider on this trade. We're looking down since this is a bearish trade, and the first midpoint level down, 67.0822. The closest strike to that is going to be the 67.10 put. The furthest out of the money strike we can consider on this trade is the closest strike to the S2 level, which is the one level down, 66.9740. So the closest strike to that is going to be the 66.95 put. So the price on the candle close for the 67.20 is 25.50, for the 67.10 20.40, and for the 66.95 14.90. Okay, so as you can see here on 11.18, we have the S2 hit here, then it backed off, and then we have the prices based on the candle close. So if you were basing it on the touch, you would have gotten better prices than these. However, as I talked about earlier, we're going to keep everything consistent and doing candle closes. So again, this is a one level move in your favor, scalp only, 100% closeout. So if you're only doing a scalp only, then your closeouts would have been on this particular hit of this level, and in this case the 67.20 was 33.10. That's a profit of $760 per option. The 67.10 was 27.60. That's a profit of $720 per option, and the 66.95 was $20.60. That's a profit of $570 per option. Now, as you can see here on the 11:36 a.m. candle, roughly 18 minutes later, we have the mid S2 S3 hit. That is a 1.5 level move in your favor on the regular trade. So 1.5 level move. Again, this is the level we're taking the trade from. This is 1 levels, and now this is 1.5 levels. The reason why we're not taking any decision here on the YDH level is that falls before the 1.5 level move. So therefore, this you are ignoring this in this case, even though it's after this, because this is a scalp only trade, and we only have these levels come into play if they occur after a 1.5 level move has minimum threshold has been met. That would be these levels down here on this particular trade, not this one. Okay, so it hits the S2, S3 level. As you can see here, slightly better on the candle close here. Prices on the candle close, 67.20 put, now 53.30, profit $2,780 per option. 67.10, $46.10, profit $2,570 per option. 66.95, $34.70, that is a profit of $1,980 per option. Here we have the S3 hit, 11:46 a.m. candle. As you can see, it touches and then backs off of it. However, these prices are based on the candle close. If you did the touch, again, you would have gotten better prices than these. This is the 2-level minimum ideal move. Here on this, again, from the S1 level, the S3, that is a 2-level move. 67.20 put, 65.10, profit $3,960 per option. 67.10, 57.20, profit $3,680 per option. 66.95, 47.10, profit 3,320 per option. Next, we have the 11:54 a.m. candle. That hits YDC. Now, this YDC level is occurring after the 1.5 level move, so that is why it's now an additional decision-making waypoint. Prices on the candle close, as you can see, are more in your favor on this particular hit. 67.20 put, now 89.30. That's a profit of 6,380 per option. 67.10, 80.50, profit 6,010 per option. And then we have the 66.95 put. My apologies here, I did not see this as far as the leaving out the profit here, so we'll just go ahead and do that. So my apologies for that. $68. So here we have the 66.95, $68. We paid $14.90. So that is a difference of $43. No, excuse me, $53.10. So that would be $5,310 per option. Okay. Now next we have the mid S3 S4 hit here, 11:56. So the price is 67.20, 93.70. It's profit of $6,820 per option. 67.10, $85, 64.60 per profit per option. Again, my apologies. I put the wrong profit in here for the 66.95. It is the $72.60 is the price. However, this profit here, again, that was the profit that should have been here. So my apologies for making a mistake here and typing it out. This is going to be 5,770. You simply take 72.60 minus the 14.90. So that's what this should be here, 5,770. So my apologies on that. Again, we'll be taking a look at the Thinkorswim charts for these on the 2-minute for each of these options here in just a few minutes, and you can see the prices for the data boxes for the various closes when it hits the different levels. So again, my apologies for that. Okay, so here on the S4 hit, we have the 11:58 a.m. candle here. On the very next candle, as you can see, it backs off. So these prices are based on the candle close. So if you did the touch instead for that, in this case, you would have gotten a better price. These prices are based on the candle close, the 67.20, 105.70, profit 8,020 per option. The 67.10, 96.70, that's $7,630 per option. And the 84.30 on the 66.95, that's a profit of $6,940 per option. Again, 84.30 minus the 14.90. Now here we have the YDL level at 12.10. So this is prices on this close here, as you can see, slightly better in your favor than the touch. The 67.20 is 119.80, profit 94.30 per option. That's $9,430 per option. Profit 67.20, 67.10 put, excuse me, $110.70. Profit $9,030 per option. 66.95 put, 97.40. That's a profit of $8,250 per option. Then here on the 12.16 candle, as you can see, it closes right on the mid S4, S5 level. That's now a 3.5 level move in your favor on this trade. Again, this trade started at S1, so 1 level here, 1.5, 2, 2.5, 3, now 3.5. 132.50 on the 67.20, that's a profit of $10,700 per option. 67.10, 122.90, profit $10,250 $250 per option, $66.95, $109.40. It's a profit of $9,450 per option. Here we have the S5 hit, 1:50 p.m. That's now a 4-level move in your favor. And again, this started S1, so 1 level, 2 levels, 3 levels, 4-level move in your favor. As you can see, this also closed through it and closed below it. So again, the candle close is more in your favor, keeping it consistent throughout. In some cases it's not, in some cases it is. So if you were doing the touch of the level instead, then you would have gotten less than this. 67.20 put, 155.80 to profit $13,030 per option. 67.10, 145.80, profit $12,540 per option. 66.95, 130.90, profit $11,600 per option. As we mentioned on the previous screen on the other trade, it's now 1:50 p.m. so you're running out of time here. So again, you would further tighten up your stop loss here because we're running out of time, or you would just close out your options here. If you did happen to have any contracts that stayed in this trade later on in the session at 3:46, with only 14 minutes to go in the session, on this candle here, you had the mid S5 S6 hit, now a 4.5 level move in your favor from this S1 bearish trade. 67.20 put, 178.30, profit $15,280 per option. 67.10 put, 168.30, profit $14,790 per option. 66.95 put, 158.80, profit $14,390 per option. Now we'll take a look at the Thinkorswim option charts. Okay, so first we're going to take a look at the strikes from the S1 bearish play. This is the at the money, the 67.20. So here we have the entry, close 25.50. Next we have the 11:18 a.m. candle, which was the S2 hit. That was the scalp. Then we have the 11:36 a.m. candle. Next the 11:46. Then the 11:54. Then the 11:56, 11:58, 12:10, 12:16, 1:50. Remember the 1:50 p.m. That was where we were saying to close out all of the contracts because we're running out of time, or further adjust your stop loss to tighten it up, since we're running out of time. And then there's the 3:46 p.m. candle if you had any contracts left over from going into the end of the session. Next we have the out of the money 67.10 on the S1 bearish play. Here's the 11:14 a.m. Close as far as the entry. Then we have the scalp close here. Then the 11:36, this is the beginning of the 1.5 level move regular trade. Next the 11:46 a.m. candle, 11:54, 11:56, 11:58, 12:10, 12:16. Here's the 1:50 p.m. candle, which we're running out of time. This is where you would have closed out all or tighten up the stop loss, as we talked about. And then here's the 3:46 a.m. p.m. candle at the end of the day, if you had any left over at the end of the day. Next, we have the furthest out of the money on the S1 bearish play, the 66.95. Here's the entry here, 11.14, 14.90. Here's the scalp, 11.18, one level scalp. Here's the minimum 1.5 level move here for the regular trade, 11.36. Then we have the 11.46, 11.54 a.m., 11.56, 11.58, 12.10, 12.16, 1.50. Again, this was the point at which you had to either tighten up the stop loss or close out all remaining contracts, as we were running out of time and we already had such a large move. No reason to risk the end of the day, so we're going to either close out everything or further tighten up the stop loss if we wanted to look at seeing any more levels that we may hit. Here's the 3:46 p.m. candle at the end of the day. Next, we'll take a look at the standard BBKPL bearish play. Remember, on the BBKPL level bearish play, that started at 11 a.m. So just a reminder of the different levels hit here. Alright, we have the 11 a.m. entry candle on the 67.40. This was the at the money on that play, the at the money standard put play on this bearish BBKPL entry. The 11:14 a.m. candle, that was the scalp. Then the 1.5 level move was the 11:16 candle for the regular trade, minimum 1.5 level move threshold. Then we go through the various levels that were hit. 11:18 a.m. candle, 11:30, 11:36, 11:46, 11:54, 11:56, 11:58, 12:10, 12:16, 1:50 p.m. Remember, that was the point at which we were running out of time in this session, and that was the closeout of everything or further adjusting the stop loss to tighten it up. 3:46, end of day. Next, we'll take a look at the out of the monies. 67.30, 11 a.m. entry. 11:14 scalp only. 11:16 1.5 level move regular trade, minimum threshold. 11:18, 11:30, 11:36, 11:46, 11:54, 11:58, 12:10, 12:16, 1:50 p.m., 3:46. Furthest out of money on this play was the 67.20 on the BBKPL bearish entry, 11 a.m. entry candle. Scalp only, 11:14. Minimum 1.5 level move regular trade threshold candle, 11:16. 11:18 candle, 11:30, 11:36, 1154, 1156, 58, 1210, 1216, 150, and then finally the 346. Next, we'll take a look at the initial BBKPL bullish entry. Okay, so this was the 9:30 a.m. entry, 67.40 at the money standard play. Next, we have the scalp closeout here at 9:56. Here's the 11:02 a.m. and 11:04 a.m. Remember, the 11:02 a.m. is if you were not taking the closeout on the S1 scalp. Instead, you were holding on for regular trade, 1.5 level move, which we did not get. So you would have gotten stopped out on the worst case scenario, the low price. 11:04 a.m. candle, worst case scenario, on getting stopped out on the standard stop loss. Next, the first out of the money 67.50 call on the opening bullish 9:30 a.m. candle trade on the BBKPL. 9:30 a.m. buy. 9:56 scalp closeout. If you were not getting out here on the scalp and instead were holding on for the regular trade, then you were stopped out on the tight stop loss, the 11:02. Worst case low 11. If you had a standard stop loss, 11.04, $8.20. Worst case scenario. Next, we'll take a look at the furthest out of the money. Here is the furthest out of the money on the opening 9:30 a.m. candle BBKPL bullish trade, the 67.60. 9:30 a.m. buy. 9:56 a.m. scalp 100% closeout. Holding on for a regular trade, 1.5 level move, which we didn't get. You were stopped out, tight stop loss, 11:02. Worst case, $7.20. 11:04. Stopped out on using the standard stop loss. Worst case, $5.20. Now we'll go back to the regular screen. Okay, so to wrap up today's video, I'd like to take the time to thank you for taking the time for watching this video. And in return for you taking your time for watching this video, if you would like to purchase this indicator, you can send us an email at daytradinggps@gmail.com to request a promo code for a discount, for a substantial discount on the purchase of this indicator. All of our indicators are sold on a one payment for lifetime access basis. That means that you make one payment and then you have access to the indicator for life, which includes any future updates to the indicator or any future versions of the indicator which we come out with additional features or substantial enhancements to the indicator. So this is the V2.0 version of the indicator. We will be coming out soon with a V3.0 version of this indicator, which will have some substantial new features added to it. And when that happens, the price of the indicator will be going up substantially from what it is now. However, if you purchase the indicator now, you will be able to purchase it at today's current price, and also from requesting the promo code, get a substantial discount, and then you will be entitled to get, as I said, any future versions, updates, or any future versions with new features. So when the V3.0 is released, you will get that version and you will avoid the price increase, as well as getting any future versions that we release in the future after 3.0. Okay, so again, thank you for taking the time for watching the video today. We appreciate you helping our channel and supporting our channel. If you like this video, please click the like button, as it does help us with the YouTube algorithm. And if you'd like to subscribe, you can be notified of any additional videos that we post when we post them. And we also have many other videos on this channel of other SPX session videos. And we also do videos on our other indicators as well, for other symbol types such as stocks, ETFs, futures, Forex, and cryptocurrencies, as well as our NASDAQ index options indicator that we have for those who like to trade NDX, the NASDAQ index options. So again, thank you for taking the time for watching the video today, and we wish you much prosperity in all your future trading endeavors. Thank you.